Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. This is our second weekly update. We came into this week with oil selling off to late Sunday night following the initial strike by Israel on Iran, where it was clear that they stuck solely to military targets, not impacting oil infrastructure and therefore oil supply. We had risen cash heading into that event, concerned that such a scenario could come to pass. And early Monday morning, we were on BNN suggesting that it would just take a few days for the washout to occur to restore imbalance of net speculative length, because we did see that uptick a little heading into the weekend. And we thought that we would recover back to roughly $70. And that's roughly where we trade today to end the week. As we look to next week, it's a big one. So we've now removed one of the key uncertainties, that being at least the market believing that the Israeli-Iran situation is now de-escalated. Event number two occurring on Tuesday is the US election. What we view is a Kamala Harris victory essentially being status quo, no impact on domestic policies, a continuance of not adhering or enforcing their own sanctions either on Russia or on Iran, and current exports of roughly 1.7, 1.8 million barrels per day continuing. Under a Trump victory, which polls and betting markets seem to suggest, we view positively for the oil price, and this is non-consensus. Consensus now believes that Trump will call everybody up, say, drill, baby, drill, and we'll suddenly get some magical increase in supply. We think that narrative has absolutely no teeth. We get that from talking directly to oil CEOs in the United States. They continue to be governed by the wishes of their shareholders, who do not want volume growth. What they want is free cash flow. What they want is share buybacks. CEOs say in a time when OPEC has spare capacity, when they voluntarily remove barrels from the market, they want to be part of the solution, not part of the problem. And we're seeing that initially now in guidance from companies with the kickoff in earnings seasons. And so we think that there will be zero impact of a Trump victory on domestic supply. We're at record high supply already under a Democrat, so permits and access to land and such has not been an issue. What's constraining growth is investors, and what is constraining growth is geology. What we're seeing corroborated by this week's inventory numbers is that production remains relatively flat. We see the ongoing themes of eroding inventory quality in terms of it not getting any more productive, and it's getting gassier. A Trump victory in our mind means that he will enforce their very own sanctions on Iran. Energy Aspects this week suggested that it could impact net exports by about 1 million barrels per day, as Chinese imports of Iranian barrels has shifted from the teapot refineries more to the state-owned companies that would be much more subjected to financial flows in US sanctions. So that's a wrap. We had inventories this week from the United States, very bullish, counter-seasonal draws across the board. We have the big three, so that's gasoline, oil, and distillates reach their lowest levels seasonally going back to at least 2016. We've had statistics coming out of China suggesting that the worst may be over. Goldman Sachs put out a chart showing that demand is up roughly 1 million barrels per day from the low. Rystad put out a real-time traffic data that seemed to suggest that we're above last year's levels for the first time, essentially year to date, and we're holding those levels too, with other encouraging data from other regions. And so that's a wrap for this week. Next time we'll have our views on the actual results of the election, and then our views on the final remaining uncertainty for energy investors, and that is the OPEC meeting on December 1st.